So the term hard money comes from, let's say, an established lender that was an asset-based lender predominantly, whether it was now or in the 60s, 70s, 80s, whatever. When people would refer back then to a private lender, meant that you went to an uncle or you had a friend that lent money that they were not an established lender. So they would call it a private loan, meaning that you were going to somebody that was lending out of their house or their office, as opposed to, a licensed institution. Alternative lending, the phrase has just always been something, when you say conventional, there's conventional terms are mandated by the companies that purchase the loan, whether it be Fannie, Freddie, or a bank or whatever. There's guidelines that they have to adhere to, and that's, that's statewide, countywide, whatever, countrywide. So those banks, anything that falls out of those guidelines would classify as an alternative lender. They might be able to say, I don't need your income, but I could have 12 months of your bank statements. Whereas we are asset-based. So we put the emphasis on the asset and not necessarily the borrower. Where a bank will put it on the borrower first, make sure that they have the credit score, the income, they pay their bills, and then they'll look at the asset second. So we're not really worried about the borrower first. We're worried about the equity we have in the asset. That's what we base our collateral on and our decision on. In the theory of people go to banks first, I think that was the case 10 years ago. But now with all the technology, we see more people going to the internet first. So, any bank, every major bank in the country, whether it be Wells Fargo, whoever, they have online applications. You don't have to go to a branch anymore. So once they get denied there, and the systems are in place where they could get an approval or denial in minutes. Anybody with a little bit of financial savvy will understand why they're not getting approved, whether it be income, the way they file taxes. You can have somebody that's a business owner that makes a very decent amount of money a year, but the way they file taxes to maintain their tax implications low might not let them qualify at a bank. So those people already know that they need to come to somebody like us that will put the emphasis on the asset, because we're not going to look at their tax returns or their income. Our bread and butter to our business is the investor. The investor that knows that they don't want to be put through the ringer at a bank with conditions and providing excessive amount of information. They know they're going to be in this property for 6 to 8 months, 10 months, a year and a half, maybe, depends on the amount of work they have to put into the property, or if they want to rent it, they'll stabilize it first and then go to a bank and get it. So with that's what we see a lot of. The investor doesn't want to provide the information that we don't require. So why us? Best reason ever. We're cheaper than a partner. You're gonna come pay 9 to 11% with us, or would you go find your cousin, your neighbor that says, hey, I'll give you the money, but we're gonna go 50-50. When you analyze those numbers, it's cheaper to come to a Benworth.